QuickBooks Online 2021. Multiple currencies, problem 4, foreign payable and forward contract maturity transactions with the help and use of Excel. Here we are in our QuickBooks Online multiple currencies problem 4 practice problem. In prior presentations, we set up a free 30-day trial so we can practice with the multiple currencies, then turned on the multiple currencies. Once turned on, can't turn it back off. So we note that before we turn it on. Now we're going to be taking a look at our financial statements by going to the tab up top, right-clicking on that tab, duplicating that tab. Going to the tab that was been duplicated, right-clicking on that tab, duplicating that tab once again. Then we're going to go down to the reports on the left-hand side, open up the profit and loss report, the P and the L. Date range change up top from 01/01/20 to 12/31/20. Run that report. Close the hamburger, hold control, scroll up just a bit to get to that 125%. Then go to the tab to the left, back down to the reports on the left-hand side, this time opening up the balance sheet, the good old BS report. Scrolling back up top, date range change here from 01/01/20 to 12/31/20. Run that report. Close up the hamburger. Prior presentations, we then put on the books a purchase of equipment that we're going to pay in the future. We're going to pay in the future with a foreign currency, and therefore we ended up with a payable in foreign currency, exposing us to exchange risk for the currency exchanges. Therefore, we also set up a forward contract, which resulted in basically a receivable in foreign currency as well. We then did adjusting entries at the end of the time period for both the receivable and the payable. And now we're thinking about this thing becoming due in the following year. First thinking about that in Excel, and then we'll take that step by step in QuickBooks. So Excel is going to be a little bit more transparent for us to see the transactions. So let's do that first and then see how we can kind of convert that over to the QuickBooks system. So once again, we put this on the books with a journal entry with the equipment going on the books and the payable using the current exchange rate in order to put that on the books. And then we said, and that would be the spot rate or exchange rate as of the first date, 12/1. And then we put the exchange account on the books so that we now have a receivable on the books, but that had to be on the books with the forward rate. And then we did the period end adjustments for the two accounts that were going to be foreign transactions, the payable and the receivable. Now we're in year 2, and we're saying this thing's going to become due in year 2. We're saying it becomes due on 3/31/2. So now we have to basically revalue our information as of that point in time and then close this thing out, meaning pay off the payable and receive the receivables and so on and so forth. Now this might be a little bit different the way you might do it in Excel from QuickBooks, because you might do like reversing entries, for example, in QuickBooks versus Excel. You might not do that as much because you're just going to record the adjustments. So you might think about how are we going to make the differentiation between the accounting department and like the adjusting department easier, which sometimes you might do a little bit differently in QuickBooks. Here we're going to do the easiest thing from a journal entry type of standpoint. So let's go back on over to the right. These are our ending balances over here, which is basically going to bring those over to our beginning balances for year 2, as we could see here. So here's our beginning balances that are just coming from the ending balances over there, and then the equity section is the whole equity section. So this whole equity section adding up to the 99.3 is our equity section. This being then basically a post-closing trial balance, or our beginning trial balance. So now we're going to have to do some of our adjustments to get our foreign currency accounts, meaning this receivable account and this payable account, to where it needs to be as of the current point in time when this thing is ended, which is 3/31 of the following year, March 31st. And then we're going to have to do the rest of the transactions to close this off, including having the dollars that we're going to need to pay off. And so we'll get into that. Let's first revalue these items. So we've got the payable down here. Let's think about the payable first. So the accounts payable, let's make that green. I'll make this green because that's the one we're working on. That one's going to be green. And it's at the 61. And now this payable was not the exchange account. It's just for this point in time. But either one at this time, we're going to have to use the spot rate. So, and that's because now we're at the end of the time period. There is no forward. There is no future speculation right now because it is what it is as of today. Therefore, spot rate. So now we're going to be taking that 100,000, times the 0.602, the spot rate at the end of this whole thing. We're at the 60,200. 60,200 is what it needs to be. What is on the books at this point in time is the 61,000. So minus the 61,000, that's going to get us an $800 difference. $800 difference. And if we consider, did it strengthen or weaken when we're thinking about the this item, we have it before it was at $1 Australian was 0.61 US dollars. Now $1 Australian is 0.602. So the Australian dollar can get less US dollars. So it looks like the Australian dollar is weaker at this point in time. And we're thinking about now a payable is the first thing we're talking about. So this time that actually worked out in our favor because we're going to be paying something in foreign currency that is weaker than it was last time we checked, at least, which was December. So we're going to have to say, all right, the payable is going to go down with a debit, and then the other side is going to be a gain. We're actually going to have a gain on this time. And let's do that calculation again. I'll do it a little bit differently this time. This is going to be equal to, I'm going to put brackets. I'm going to take the prior rate, which was this 0.61, minus the current rate, which was 0.602, close up the brackets, times then the 100,000. Once again, that's that $800 difference calculated slightly different way. That's our debit, that's our credit. Let's post it out and see what happens over here. Posting this out. The accounts payable, this is going to be equal to the $800, getting us to that 60,200, which I believe is what it should be. Let's double check it one more time. Double check. 100,000 times the current spot rate, 0.602, 60,200. Checked 2 times. 2 checks by that thing. There's 2 checks by it because we double checked it. And then down here, foreign currency transaction is going to be equal to the 800 credit now. So there is that one. And then we're going to do the other one now. So let's make this one like yellow. And let's greenify the one we're going to do. Green's the one we're on. Green is going on the one that we're on. And so, and that's not even the right one. It should be down here. Greenify this one. And let's ungreenify this one because that's like nothing right now. So there we have it. So now we've got this 61.2 in the receivable from the broker item. Now this is the one that we had to use the forward rate, but now it is as of this point in time. So we're going to use the same spot rate because it is what it is as of now. So once again, we got the 100,000 times the current spot rate, 0.602, 60,200. Notice everything's going to line up, we're going to see that 60,200 a lot. So then I'm going to be saying minus the 61,200. That's an adjustment of $1,000. $1,000. So if we can compare this, where were we at last time? $1 Australian on the forward rate was 0.612. Now $1 Australian is 0.602. So that means $1 Australian can be purchasing less US dollars, and therefore it has weakened. And we're talking now about a receivable. So the fact that we're going to receive Australian dollars that are now weaker than they were last time we checked is going to be bad. It's going to result in a loss in this case. They're not the exact same amounts because we had to use the forward rate and the spot rate and so on. But you could see how they're kind of equal and or they're opposite but not equal. And the fact that they're not equal is what we would kind of expect. So let's do that calculation. We're going to have a loss then up top. Last time gain, this time loss. And then we're going to say that the other side is going to go then to this, this foreign currency receivable account. So the foreign currency receivable account, let's calculate it again, but a different way this time, equals brackets. We're going to say this is where we were last time, minus the current rate, 0.602, close up the brackets, times the 100,000. There's our $1,000 on the debit and on the credit. Let's go ahead and post this out down below. So we've got the income statement. We're taking the debit of the 1,000, and then the foreign currency here. We're going to say this is going to be equal to the 1,000, and that will take us to, once again, that 60,200 because everything's terminating at this point in time. Everything's going to be lining up to that 60,200 at this point. So now Next thing we could do that's fairly easy. Now we can kind of close this whole thing out. Next thing we could do is say, well, this payable was in US dollars. So the payable, this was the exchange broker payable. It hasn't changed since the first point in time we put it on the books. It's the end of the time period now, so we promised to pay the broker the 60,900. They're going to pay us 100,000 Australian dollars, now valued at the 60,200. So we can pay this one off. That's a straightforward transaction. That's going to be a debit then to the dollar payable here, and a credit simply to cash. And we're going to then pay off the same amount, which is just the $60,900 that hasn't changed since the beginning. Let's recalculate it just so you can see where it came from. It was simply the 100,000 times the spot rate at the beginning when the forward contract was put on the books, because that's what they thought it would be at that point in time. And the cash and the currency of the US dollar is the side that doesn't change. So then we're going to say that this is going to be then equal to the 60,900, bringing it down to zero. Just the normal payable goes down to zero because we paid off the cash. And cash then goes down by that 60,900. No foreign currency weirdness happening with that one. Then let's pay off or let's say that we're going to receive these foreign currency receivable. And the reason I'm going to do this one first is because I want to receive this money in foreign currency before I do the payable. So because I can't really do the payable until I have foreign currency units, and either I transfer cash to get those foreign currency units, 100,000 Australian dollars, which would be equivalent to 60,200 now, or I get the 100,000 Australian units from the exchange broker and then pay off the payable. So that's what I'm going to do. I'm going to get the money from the exchange broker first and then pay off the payable. So what we're going to get from the exchange broker is the 100,000 Australian dollars, which currently, using the current exchange rate, is equal to the US equivalent of 60,200. We're getting money, but not cash, but foreign currency units. Therefore, we're going to record it as like an other cash account here that is holding foreign currency units. It's kind of like holding stock. You can think of it in terms of recording, because we're still going to value it in US dollars. We're not going to say this is how many stocks we have. We're not going to say this is how many foreign currency units we have. We're going to say this is the US equivalent in terms of dollars of the foreign currency units. So this is going to then be the foreign currency units are going to go up. And once again, we can recalculate it just so you can see where the calculation comes from. It's going to get that 60,200 once again. It's going to be the current spot rate times the $100,000. There we have it. And then the other side is going to be then going to be the cash is what we're getting, and we're taking down the receivable. The receivable is going down. That makes sense. Okay. And that's going to be the debit and the credit. Let's record this out. So now we've got the foreign currency units are going up because we're getting actually 100,000 Australian dollars, which is represented on our financial statements at 60,200. And then this receivable right here, which has 60,200 in it, is going to go down. So we're going to say plus that 60,200 credit here, this one, is going to make it go down to zero. So now we've gotten paid on that one. Now we have 60,200 US dollar equivalents representing the 100,000 foreign currency units, which are actually in the bank account, which we can now use to pay off the accounts payable, which we owe in foreign currency units, 100,000 Australian dollars, which once again we have revalued to the current time period, which is 60,200. So now we can take that 100,000 Australian dollars and pay off, and that will be paying off this transaction. So we're going to say, all right, that means that the accounts payable is going to be debited, and that means that the foreign currency units are what we're going to spend to do that. And once again, let's do the calculation again, just so we can see where it comes from. 60,200 calculated as the current spot rate times the 100,000 Australian units, which is what we're actually giving at this point, but we're valuing it at the current US equivalent using the current spot rate or exchange rate. So here's the accounts payable. Here's the accounts payable. I'm going to double click on it, go to the end of it, say plus, and we're going to say there's the 60,200, bringing it down to zero. Here's the foreign currency units, going up to the foreign currency units up top, double clicking on it, going to the end of it, plus, picking up the 60,200, bringing it then back down to zero. So there we have it. So now we've got the cash on the books. We used the foreign currency units to pay off the payable. We've got the foreign currency receivable has now been received. And then the depreciable asset, this is important to note, is on the books at $60,000, which is the first transaction we put on the books. We didn't change the asset, in other words, due to the fluctuation in the foreign currency units for either the payable related to it or the forward contract related to it. And that's important to note. And if it was a hedge, that's where you might see some differences. If you categorize it as something different, then you could see, but you could see why someone might say, hey, you should be adjusting. You can argue from just a theory standpoint, you should be adjusting the depreciation because you didn't really pay $60,000. You paid, something different based on these forward exchange rates and whatnot. But that's not typically what we do. Normally, we just put it on the books at the current exchange rate that we purchased it for, and then we recorded the differences in the currencies down here in a gain and loss as they happened. Also note that if we net these two out, we've got then differences between the gains and losses. That's what we would expect if we're using the brokerage fund, the forward contract, as a mitigation tool. We expect them to go opposite ways, although not perfectly opposite in terms of amount, due to the differences in the rates that we're going to be using. Those net out to 200. If I look at those netting out to the 200 and these netting out up top, the total difference is the $900. So we have to then allocate between, year one and year two. So now we're going to think about doing this in Excel, and we want to think about this and say, well, do we want reversing entries to do this, or do we want to do this with just straight journal entries as we did here? How do we separate between the accounting department and possibly the adjusting department for a little bit of added complexity with it? And so we'll do that in a kind of step-by-step process. Now in QuickBooks, this being our outline, which hopefully is a little bit more transparent, although a little bit intimidating to look at, and then take it piece by piece and convert it to QuickBooks, which is a little less transparent, a little bit more magical, but a little bit easier, hopefully, to do the data input.